Introduction. In corporate finance, managing financial risk is essential to safeguard assets, stabilize earnings, and protect shareholder value. Financial derivatives are sophisticated instruments used for hedging risks related to interest rates, currency fluctuations, commodity prices, and more. This module explores risk types, risk measurement, and the use of derivatives for effective risk management. Types of financial risks. Market risk. Risks from price fluctuations in markets. Equities, interest rates, commodities, currencies. Credit risk. Risk that a counterparty defaults on obligations. Liquidity risk. Risk of being unable to buy or sell assets without significant price change. Operational risk. Risks from failures in internal processes, systems, or fraud. Legal and regulatory risk. Risks from changes in laws or regulations. Measuring risk. Standard deviation and variance. Measures the volatility of returns, indicating the total risk of an asset. Beta point. Measures systematic risk, or the sensitivity of an asset's returns relative to the overall market. Value at risk, VAR. Estimates the maximum potential loss over a given time frame at a specified confidence level. Risk management techniques. Risk avoidance. Eliminating activities that generate risk. Risk reduction. Implementing controls to minimize risk. Risk sharing. Transferring risk through insurance or contracts. Risk retention. Accepting risk when cost of mitigation exceeds benefits. Financial derivatives overview. Derivatives derive value from underlying assets and include forwards, customized contracts to buy-sell assets at a future date and price. Futures, standardized forward contracts traded on exchanges. Options, contracts giving the right, but not obligation, to buy-sell an asset at a set price before expiration. Swaps, agreements to exchange cash flows, commonly interest rate or currency swaps. Uses of derivatives in risk management. Hedging, protecting against adverse price movements. Speculation, taking positions to profit from price changes. Arbitrage, exploiting price differences across markets. Example, using futures to hedge commodity price risk. A firm expecting to buy oil in 6 months can use oil futures contracts to lock in prices, mitigating the risk of price increases. Regulatory and ethical considerations. Compliance with financial regulations. Ethical use of derivatives to avoid market manipulation. Transparency and disclosure to stakeholders. Summary. Risk management and financial derivatives are vital tools in corporate finance. Understanding the nature of financial risks and employing derivatives judiciously enables firms to protect their financial health and create strategic advantages.